Welcome back to the deep dive. If you are operating in the digital asset space right now, you know that the sheer velocity of new projects, new chains,
Yeah.
it makes it virtually impossible to keep up.
It really does.
We're seeing major innovations happening every single day, particularly on layer 2 solutions like Base.
Yeah, the pace on L2s is just, it's staggering.
And you came to us with a stack of curiosity about a specific project, Edel. Specifically its trajectory and, its integration within the base chain environment.
Right.
So our mission today is not just to summarize. We're going to perform a true, extensive examination of this project, really cut through the noise to give you the strategic intelligence you need.
That's absolutely right. And when we look at Edel, you'll see it as Edel Finance or Edel Coin.
Huh.
We see a fascinating tension.
Mm.
It's a project that, on one hand, aims for this kind of institutional stability, linking digital tokens to actual physical assets. But on the other hand, it's choosing to operate on a fast, modern, and let's be honest, often volatile chain like Base.
So that's the core conflict we're digging into.
Exactly. Our deep dive is investigating 4 core pillars. The professional pedigree of the people building it, the complex mechanics of their collateral model, the dizzying recent price movements, and critically, the integrity of the underlying smart contract.
Okay, so we've compiled and cross-referenced sources covering all of that. The team's traditional finance backgrounds, the specifics in their white paper about the collateral, recent market data, which, spoiler alert, is pretty dramatic,
Very dramatic.
and third-party analysis on contract security.
Yeah.
You're going to extract every little nugget of knowledge to make sure you understand what this project is built on, what its goals are, and why it's performing the way it is right now.
Our goal is really to move beyond those surface-level descriptions and, connect the dots, connect the institutional decisions the team made with the behavior we're now seeing in the market.
Okay, let's unpack this. What makes this particular project stand out in the rapidly evolving Base ecosystem? Usually when looking at a new token, you'd start with the tech.
Right, the code.
But here, the story really begins with the people.
Yeah.
So let's start with the foundation, the professional pedigree and the core mission they're setting out to achieve, because that really sets the stage for everything else.
I think that's the perfect place to start.
So the crypto space is famous for having teams that are, fully decentralized, sometimes anonymous.
The classic degen devs.
Exactly. Or, teams comprised solely of engineers who have never built with a compliance officer in their life. But the initial finding here, based on the documented backgrounds of the Edel team, is it's fundamentally different.
It's the complete opposite, really.
This team seems purpose-built to bridge that gap between Wall Street rigor and blockchain speed. We're seeing traditional finance credentials mixing directly with modern tech.
And what's fascinating here is the sheer weight of that institutional finance experience. The source material explicitly mentions that the Edel team boasts backgrounds from established financial and technology companies like State Street and JP Morgan.
And these aren't just names they're dropping casually.
No, not at all. They represent a very specific institutional mindset.
State Street, that's a custodian giant. JP Morgan is one of the world's most sophisticated investment banks. If you're building a project that is literally tokenizing physical assets, real-world assets, or RWA, and you're prioritizing stability and compliance, well, having institutional knowledge from those places seems like an immediate advantage.
It is, but it could also be a limitation, as you hinted.
How so?
Well, we need to focus our analysis. It's not just that they worked there, it's what they learned there.
Right.
Individuals coming from institutions like State Street, they bring decades of experience in asset management, institutional custody, regulatory adherence, risk assessment for, massive pools of capital.
Okay.
They know how to structure things that must withstand the audit and legal scrutiny of global financial regulators. This is crucial for a project that aims to link real-world physical assets, in this case metals, to a digital token. They understand that, the legal and logistical prerequisites for something to be considered institutional grade.
I see the benefit for custody, for compliance. But doesn't anchoring the project so firmly in traditional finance risk sacrificing the speed, the low fees, the true decentralization that a layer 2 like the Base chain demands? If you're trying to be as compliant as JP Morgan, why are they even on a decentralized chain to begin with?
That is the essential friction point, and it dictates their entire approach. The choice of Base is strategic. It offers Ethereum-level security combined with the throughput and low transaction costs you need for mass adoption.
Which is vital if you're minting and moving tokens that represent physical value quickly.
Precisely. However, that institutional experience dictates that their decentralization must be, well, let's call it managed.
Yeah.
They aren't aiming for the radical anarchy of pure DeFi. They're aiming for trustless verification, which they get from the blockchain combined with trusted custody.
The TradFi protocols they understand.
Exactly. They want the best of both worlds.
And the team composition reflects that dual mandate, because the sources also point to expertise pulled from a major rapid-scaling tech company, Airbnb.
Right. And that blend is the strategic differentiator. While the JP Morgan experience handles the why and the how of financial structuring, compliance, and asset risk, the expertise from a modern platform like Airbnb suggests.
Yeah.
Well, it suggests proficiency in scaling consumer platforms rapidly.
User experience, efficient tech deployment.
All of that. In a digital-first environment, they're bridging the gap between old-world security requirements and new-world deployment speed. They know how to build a front end and an infrastructure that actually works seamlessly, which is often a major, major pain point for these complex RWA projects.
This sets a strong baseline. Professional rigor combined with tech agility. Okay, now let's pivot to what they're actually trying to build. Edelcoin isn't just another token. It has a very specific purpose and mechanism, and it's all outlined on their official site, edelcoin.com.
The project's whole identity revolves around providing a mechanism for value storage and transfer with low volatility. But, and this is the interesting part, it's achieved through a unique and pretty complex collateralization method.
Okay, so it's not just a stablecoin pegged to the dollar.
No. Edelcoin is collateralized not by a single fiat currency, but by a diversified basket of precious and base metals.
This is where we need to dive deep. Simply saying metal-backed is, well, it's not enough.
Not even close.
The complexity of managing physical, tangible commodities on a distributed ledger is immense. So what are the logistical challenges, and how does this specific basket aim to mitigate volatility compared to, say, a gold-only peg?
The challenge is really threefold. You have composition, custody, and auditability.
Let's start with composition.
Okay, so first, composition. A basket of metals is a very deliberate strategy. Precious metals, like gold or silver, are traditionally used as inflation hedges, but can sometimes be highly correlated with, global risk-off events.
Right, everything goes down together.
But base metals, think copper, aluminum, and potentially others in the platinum group metals, which are highly industrial, they often correlate with industrial output and economic expansion.
Ah, so they're counter-cyclical to each other?
To some degree, yes. By combining them, Edel aims to create a collateral profile that provides a buffer against volatility that a single asset just can't offer. If the economy crashes, gold might surge. If industrial production ramps up, copper may surge. The basket is meant to smooth out that curve.
Okay, that makes sense. So what about the second part, custody?
Custody. This is where the State Street and JP Morgan background is absolutely crucial. The metals have to be physically stored, insured, and secured. And not just in one place. Likely in multiple high-security third-party vaults across different jurisdictions to mitigate that single point of failure risk.
And their institutional experience informs the exact legal agreements needed for all that secure off-chain asset management.
Exactly, which crucially leads to auditability. How can a token holder on the base chain trust that the physical assets truly exist and haven't been, double pledged or something?
Right, the classic problem.
This requires a highly structured external auditing schedule. The white paper, which we'll get into more in the next section, outlines its claim to high transparency, which in this context means regular mandated third-party audits of the physical vaults. The token holder needs confirmation that the weight of the metals in the vault equals or exceeds the total circulating token supply.
Without that institutional rigor on the back end, the digital token is, well, it's worthless.
It's just another line of code.
From a purely technical standpoint, the sources confirm it's issued as a standard ERC-20 token. This means the actual token structure adheres to the most established, well-audited smart contract conventions on the Ethereum and Base networks.
Right, and that simplifies the digital risk while they focus all that complexity on the off-chain collateral. And the stated goals from their public documentation, achieving low volatility and maintaining high transparency, are inherently linked to this mechanism. They believe that by tying the value to this diverse, physically audited basket of commodities, they can provide a steadier, long-term store of value that's resistant to both fiat inflation and single asset shocks. This sophisticated approach really answers the core question for anyone studying this. What is this token, and how does its value strategy reflect the pedigree of its creators?
Okay, so a great team and a clever, complex mechanism. That's only half the battle in the decentralized world.
Right.
In fact, a complex mechanism requires more trust, and that trust is built on consistent, clear, and comprehensive communication. We need to know if the team is actively engaging with the community and, most importantly, providing a clear, auditable map for the future.
This is where we gauge their operational transparency. And the sources confirm they have certainly established an active digital footprint. The team's promotional and operational updates are confirmable through regular updates across multiple digital channels.
Let's focus on the volume and the placement of these updates. We look specifically at their presence on X, formerly Twitter.
Yeah, their X handle at edel.finance is highly active. It's boasting over 300 posts dedicated to project updates, technical disclosures, community interaction. That volume, over a relatively short period, signals a pretty strong commitment to avoiding the perception that the project is a black box.
Which is a huge red flag in crypto.
Yeah.
An inactive social presence is a death knell.
It is. 300 plus posts indicates they're trying to keep up with the pace of the market.
But beyond just the sheer volume, what do these updates focus on? Is it just price hype, or are they talking about the detailed mechanics?
They appear to focus heavily on project milestones, integration updates within the base ecosystem, and significantly updates related to their compliance journey and the underlying collateral.
So the content itself reinforces their institutional identity.
Absolutely. They're trying to talk about stability and adherence, not just short-term gains.
And the sources confirmed they're not just on X, they're diversifying their channels.
That's right. We noted additional communication channels, including a dedicated Teleguard channel, which suggests they recognize the need for secure, maybe more instantaneous communication with serious stakeholders.
Interesting choice.
And of course, the central repository of information, the official website, edelcoin.com. They're deliberately using multiple platforms to ensure that information, from minor daily updates to major strategic shifts, is broadly accessible.
That brings us to the most comprehensive and crucial piece of their documentation, the white paper. In the crypto world, this document is basically the project's constitution. Its availability and its quality speak volumes about true transparency, especially given the complexity here.
For sure. The detailed white paper is available directly on the official website. This is like non-negotiable for a professional RWA project. If they're asking for serious investment, they have to be willing to articulate their entire structure and goals publicly.
Okay, here's where it gets really interesting. We need to analyze the specific content of that white paper. Given their focus on compliance, what precise elements of their structure and strategy are clearly mapped out for you, the public?
For a project leveraging physical assets and these institutional backgrounds, the documentation has to go way beyond the standard crypto jargon. And the Edel white paper is comprehensive precisely because it addresses those institutional concerns head-on.
What does that look like in practice?
It explicitly outlines the mission and vision, tying the metal basket to global economic stability aims. But more importantly, it dives deep into the collateralization mechanism. It has to specify the minimum ratio of collateral to circulating tokens, the process for periodic rebalancing of the metal basket, and how the value is calculated against the token.
That level of detail is necessary to assure investors of the inherent floor price.
It is. Then you have the security and compliance sections, which are likely heavily influenced by that JP Morgan and State Street expertise.
I'd imagine those are central to the whole thing.
They are. The white paper details the security protocols, how the digital contract interacts with the physical world, often through things like multi-signature mechanisms and oracles. It also directly addresses compliance measures.
This is a big one.
It is. This is a direct reflection of their TradFi backgrounds. They have to lay out their stance on KYCM, know your customer anti-money laundering requirements, especially if they intend to court institutional investors. They get that for a project dealing with real-world hard assets. Compliance isn't optional. It's the foundation for widespread acceptance.
And for a long-term asset, they have to address the future.
Absolutely. The document also lays out detailed sustainability and governance plans. This demonstrates a long-term view that extends far beyond just immediate token velocity. It addresses the legal structure of the entities holding the collateral, the audit schedule, and the mechanisms for future protocol upgrades.
So the commitment to providing this depth of documentation really checks the box for institutional readiness.
It does. The emphasis on specific collateral management, security, compliance, and sustainability, all communicated through this comprehensive documentation. It signals a very deliberate and stable operating strategy. It communicates their future goals clearly, which is a key sign of high transparency, especially in the often opaque RWA sector.
So transparency in this context is really measured by the specificity of their disclosure.
Exactly. They aren't just saying, we have metals. They're articulating the audit trails, the legal entities, the procedures for verification. The whole communication infrastructure is mapped out to support a long-term, compliance-heavy asset.
Okay, we've established the foundation. Professional team, detailed collateral mechanism, robust transparency. Now we move from the planning and the governance to the real-time dynamics, the market.
Where the rubber meets the road.
Exactly. You, the listener, specifically asked us to examine the price movement of Edel on the base chain. And the data, as of November 18th, 2025, shows a massive contradiction. This token is designed for low volatility, yet the recent chart action has been explosive.
This is where that tension between institutional ambition and crypto market reality truly manifests. While the long-term design is all about stability via collateral, the short-term market has shown significant speculative energy. We've seen a recent dramatic surge that completely contradicts the project's core ethos.
Let's nail down the specific data points that illustrate this anomaly. What exactly did that surge look like, and how quickly did it happen?
The data is stark. Over a concentrated 24-hour period, Edel experienced a 27.2% increase in value.
27%.
In a day. This is explosive growth, particularly for an asset that's designed to track the steady value of physical commodities. This aggressive buying pressure propelled the price to an all-time high, an AT of 0.0565.
Wow. A 27.2% jump in one day is massive. It suggests a sudden, huge influx of capital. For a token trading in the multi-millions of dollar market cap, this indicates millions of dollars entering the market in a highly compressed time frame.
It does.
So where's the price sitting now after that spike? Is the market just giving back all those gains?
It has not. It's currently trading slightly lower at about 0.055 cents. So that reflects a minor correction of about 2.5% down from that all-time high. The vast majority of the gains are holding.
So the market has reset its baseline value for the asset substantially higher than it was before the surge.
It seems so.
Okay, so we have rapid, significant recent growth, followed by only a very minor, controlled correction. This is the definition of an inflection point. What could possibly drive a stability-focused asset to jump 27% in one day? This level of movement just isn't typical for metal-backed tokens.
We have to hypothesize the drivers, and there are typically three strong candidates for such rapid, non-organic movement in an RWA asset like this.
Okay, what are they?
First, a major exchange or platform listing. The listing of Edel on a significant exchange or its integration into a major DeFi platform on Base could trigger this. Increased accessibility drives liquidity and demand almost instantly.
Right, more eyeballs, more buyers.
Second, institutional whale entry. Given the project's background, it's highly plausible that a single large institutional buyer, a hedge fund, a family office, even a corporation, made a massive initial investment.
Which would validate the asset for others and spark retail interest.
Exactly. This is the kind of capital that respects those TradFi compliance structures we talked about. And third, and maybe most relevant here, base chain narrative integration.
What do you mean by that?
Base is growing incredibly fast, and there's increasing interest in compliant assets that can bridge the institutional world to this low-cost L2 environment. Edel could have been featured as a foundational RWA asset within the broader Base roadmap, signaling future stability and becoming a core narrative asset for the chain itself.
The tension here is palpable. If the long-term goal is stability, this sharp volatility is a market contradiction that investors have to reconcile. Is this surge a temporary malfunction, or does it signal that the project has successfully attracted the necessary capital to reach critical mass?
Well, market platforms that offer predictions provide a vital counterbalance to this short-term volatility. Despite the recent spike, they generally project expectations of slow but steady growth through 2030.
So the analysts see this as a blip.
It suggests that the analyst community views the volatility as a market reaction to news or adoption, not a change in the fundamental long-term nature of the asset. They still fundamentally believe in the collateralization model as a long-term stability mechanism.
That contrast is powerful. Extreme short-term excitement versus a projection of almost, well, institutional steady stability.
Yeah.
Now, how's the community reacting to this sudden surge? We looked at the mechanisms for gauging sentiment.
Right. And the project has professionally built the necessary infrastructure. They feature a module that allows users to analyze market trends and sentiment right alongside the price charts. This is a very professional, modern approach. They're giving investors the tools for their own due diligence.
Providing those tools suggests they want a transparent, data-driven community discussion. But is the community actually using those tools to generate meaningful trending discussion about this sudden 27% surge?
Well, the data we saw noted moderate community engagement at this point.
Moderate.
Yes. While the infrastructure for feedback and sentiment tracking is there, the volume of discussion or specific trending sentiment about this massive price surge, it wasn't overwhelming or directly visible in the immediate data.
That's a key distinction, and it connects right back to Section 1. If the project is designed by TradFi veterans and backed by physical assets, the investor base might inherently be different.
How so?
Less prone to retail FOMO discussions and more focused on passive holding and long-term asset appreciation.
Exactly. High engagement usually correlates with highly speculative assets, meme coins, high APG DeFi protocols. A metal-backed, compliance-focused asset is attracting a different demographic. The moderate engagement contrasts sharply with the sharp price action, which raises a critical question.
Was this surge driven by institutional or whale interest, which generates very little public noise rather than broad retail excitement, which dominates public forums?
I think that's the key question. The moderate engagement is an important data point suggesting the project's success might be coming from large capital movements that happen outside the usual echo chambers.
Okay, we've established the team is professional, the goals are complex, and the price action is dynamic but contradictory. Now we get to the core foundation of trust in the blockchain world: contract integrity.
The bedrock.
If the code is flawed, everything else, the TradFi background, the metal collateral, the compliance documents, it all collapses. Let's shift to the crucial technical question of token integrity.
The foundation here is reassuring. The documentation confirms that Edel coin utilizes a standard ERC-20 contract for an RWA project balancing immense off-chain complexity, like managing metals, with the need for digital trust. Adhering to the most established, battle-tested standard on the Ethereum ecosystem is critical.
So using a standard contract minimizes the risk of introducing novel proprietary vulnerabilities. They are effectively simplifying the digital attack surface.
Correct. It allows them to concentrate their security efforts on that complex interlink between the physical collateral and the token mechanism.
Right.
When you have a complex RWA structure, you want the on-chain representation to be as simple and secure as possible. Furthermore, the project's documentation boasts about transparency in transactions and explicit proof of provenance. This is the mechanism that links the auditable token back to its physical metal collateral.
Conceptually, how does proof of provenance work for a basket of metals?
It means that every token minted, or at least every batch, has a transparent auditable linkage back to a record confirming the existence of the specific metal reserves backing it.
Like a digital serial number.
Think of it exactly like that. A digital serial number on the token that corresponds to an entry in the collateral registry, which is maintained by the vault custodian and the auditors. This allows for transactional transparency. It ensures that when tokens are minted or burned, the required adjustments to the physical inventory are logged and verified through external third parties.
That's the crucial intersection of the TradFi custody experience and blockchain transparency.
It is.
So given this system, how does the security assessment look in practice? Were there any reported breaches or major flaws specific to the Edel contract since its launch?
The good news here is pretty straightforward. No recent major issues or contract vulnerabilities have been reported for the Edel contract itself. The core smart contract appears sound, leveraging the reliability and wide acceptance of the ERC-20 standard. This provides a clean bill of health regarding the token's intrinsic security.
Okay, that's good. But we have to consider the environment they operate in, the base chain. No chain is immune to growing pains. Were there any contextual issues related to the broader L2 chain that could have potentially impacted user experience?
That's the necessary layer of nuance, and it's a vital point for anyone analyzing assets on growing L2s. The sources we looked at noted generalized issues across the base chain regarding token metadata delays.
Metadata delays. What does that mean?
These were discussed in developer forums like Morales, indicating a technical friction point for the base network generally, not just for Edel.
Okay, but we can't just dismiss this as a display bug. For the sophisticated investor, what does a metadata delay issue truly imply about the chain's health, even if it's not a contract vulnerability?
So metadata refers to the descriptive off-chain information attached to a token. The symbol, the name, the logo, crucial data like the number of decimals. Delays in metadata retrieval mean that specific indexing services, the way wallets or explorers like Etherscan read and display token information, are struggling to keep up with the transaction volume on base.
Ah, So it's a scaling issue for the chain itself.
It is. This doesn't compromise the security of your funds. The transaction is still executed and immutably recorded. However, it implies that certain network infrastructure elements, specifically the indexers or public RPC nodes, are occasionally overloaded or behind schedule. It's a chain-level scaling challenge. If you try to view your token and the wallet displays a generic address instead of Edel coin, that's the delay manifesting.
So it's a symptom of heavy load on Base,
Yeah.
maybe related to its rapid growth, but not a flaw in Edel's specific code. And critically, was there any evidence that this generalized base chain indexing issue actually compromised Edel's core function, its transaction security, or its ability to interact with the collateral mechanism?
Critically, no. The sources confirm there is no evidence that this broader base chain issue impacted Edel's actual contract security or its core operations. Transactions were processed correctly, and the connection to the underlying collateral was maintained. It just reinforces the conclusion that the Edel contract itself is robust. It's utilizing standards that can withstand the technical growing pains of a highly active host environment like the base chain.
So what does this all mean for the security summary? The technical foundation appears sound. They utilize established, simple standards ERC20 to manage a complex product. They prioritize transparency and transaction tracking with proof of provenance, and most importantly, there are no specific red flags tied to the Edel contract itself. That provides a significant level of reassurance for a project positioning itself for long-term compliance and stability.
They built the digital component correctly so that it could weather the storm of an actively scaling chain.
That brings us to the synthesis phase of this deep dive. We started with a stack of raw data about a unique project sitting at the intersection of Wall Street and the base chain. And I think we've emerged with a very clear, nuanced picture of Edel. Let's just quickly review the 4 pillars we've established for your knowledge base.
Sounds good. So we've established a pattern of high professional rigor. The team features backgrounds from TradFi giants like JP Morgan and State Street. That informs their dedication to compliance, risk management, secure asset custody.
And that's all balanced by the tech agility they need to deploy effectively on a layer 2 like Base.
Right. Their core model is innovative. They're seeking true stability via collateralization by a diversified basket of precious and base metals, a mechanism designed to resist volatility better than any single asset peg.
Pillar 2. Communication is active, specific, and detailed. They have a high volume of posts on X, they use secured channels, and they produce a comprehensive white paper that outlines security, compliance, and long-term sustainability. It demonstrates a willingness to disclose the complex legal and logistical underpinnings of an RWA project.
Then there's the market performance, which shows that powerful contradiction. While aiming for low volatility, the token saw a sharp recent 27.2% price surge. This suggests a massive institutional or whale capital inflow, which has since stabilized.
But the market platforms still project a slow, steady growth trajectory through 2030, suggesting analysts view the volatility as an adoption event, not a failure of the stability mechanism.
And finally, contract integrity. It's robust. By relying on that battle-tested ERC20 framework, the contract itself has avoided reported major vulnerabilities. It's successfully navigating the technical landscape of the base chain, even overcoming those broader chain-related indexing issues without impact to core security.
So in summary, Edel on the base chain is a project built with institutional rigor applied to a novel collateral structure. It features a credible team, robust compliance documentation, and clear intentions. But it must constantly manage the tension between its mandate for low volatility and the highly dynamic market environment it chose to operate in.
That's the tightrope they have to walk.
Now, here is a final provocative thought for you to chew on as you synthesize all this information. We've seen the expectations of slow, steady growth through 2030. The ultimate goal of a stability asset juxtaposed directly against that sharp 27% recent surge. And we noted that while the team provides the tools for engagement, the overall community presence is currently moderate. The central question for anyone evaluating this project's longevity is this. The team is anchored in a tradition where trust comes from audited custody and legal structure, not community hype. But the token lives on a chain driven by community narrative and speed. Does the complexity of the physical asset custody, the necessary black box of the vault, inevitably conflict with the core transparency ethos of the blockchain? And can institutional trust truly outweigh the need for vibrant, visible decentralization in the long run?
That is the ultimate calculation of risk versus reward for any RWA project on a decentralized chain. It's something worth pondering as you decide what this knowledge means for your understanding of the space.
Thank you for taking this deep dive with us. We'll see you next time.